This episode is brought to you by Progressive Insurance. You chose to hit play on this podcast today. Smart choice. Make another smart choice with Auto Quote Explorer to compare rates from multiple car insurance companies all at once. Try it at progressive.com. Progressive Casualty Insurance Company and Affiliates. Not available in all states or situations. Prices vary based on how you buy.
Funding for the Think podcast comes from Wise, an app for people using money around the globe. With the Wise account, you can send, spend, and receive in up to 40 currencies. You can download the Wise app or learn more at wise.com. Terms and conditions apply.
When we believe that government programs are working well, we tend to like them just fine until tax time rolls around and we're faced with the reality that some share of the money to run those programs comes directly from us. We love tax cuts that promise to let middle and working class Americans keep more money. But if raising taxes on regular people, even to fund popular programs, is a hard sell, who could object to taking more from the tiny subset of Americans who quite literally have more money than they could spend in a lifetime? From KERA in Dallas, this is Think. I'm Chris Boyd. Lately, there's lots of talk about taxing billionaires. Advocates in California are trying to get a one-time levy on the state's billionaires onto the ballot for November. At the federal level, Senator Bernie Sanders and Representative Ro Khanna have a plan they say would take money from fewer than 1,000 Americans and generate revenue to meaningfully improve the finances of every American household earning under $150,000 a year. Why wouldn't every non-billionaire be excited about this? My guest is here to explain. Megan McArdle is a columnist at The Washington Post, where you can read her article, The Myth of the Billionaire Wealth Tax. She is also host of the podcast Reasonably Optimistic. Megan, welcome to Think.
Thanks for having me.
So as I mentioned, there are a couple of versions of this floating around right now. The Bernie Sanders-Ro Khanna plan is called the Make Billionaires Pay Their Fair Share Act. What do Sanders and Khanna think would be a fair share amount for billionaires to pay?
5% of their wealth. And look, I think I understand why people look at that money and think, well, they can't even spend what they have. Why not just take it and do something better with it? But as I write in the column, it's a little more complicated than that for a few reasons. And the first is that taxes are actually much harder to collect than you think. So this is what economists and social scientists call state capacity. And it actually took quite a long time to build up the modern state capacity to collect modern income taxes. It was not an overnight process. We've been refining that for the last century and more since the first income tax was passed in 1913. And when you look at California, for example, where they have this separate billionaire wealth tax, it's really unclear how they would even get the capacity to value the assets they want to tax and to figure out what they are, since it's only a one-time tax. But the other issue is that even for larger federal governments that have a big investment in this, that have levied taxes, these taxes on wealth are surprisingly hard to collect, in part because so much of the wealth is tied up in things that are much harder to value than, say, a house or a public, like a share of a stock in a public company. So if you think about like a billionaire compound, these are, if you ever read the mansion section of the Wall Street Journal, as I admit I do, guilty pleasure. One thing that you'll notice is that these people can put their houses on the market and then drop the price by like $20 million when it doesn't sell, and that they stay on the market for a long time. And that's because there's relatively few people who can afford to buy these properties. They trade relatively rarely. Each property tends to be bespoke. It's not like a subdivision where there's 90 identical houses and you can
run the comps
to a pretty good approximation. Yeah, you have good comps, right? Each one of these things is you've got to figure it out. Now multiply that out to privately held companies or art, jewelry that is, a rare one of a kind piece, often an antique, and so on and so forth. Illiquid things like timberland, right? All of those things. A yacht. What's the resale value of your yacht? Who knows until you sell it? And so what you do is you end up spending a lot of time fighting, first of all, over how to value the assets. Wealthy people often try to change assets into things that are harder to value. And then when they are liquid, you have difficulty getting your hands on the money. So one of the canonical examples that has been going around is, say you are a startup founder. You founded your startup 5 years ago. It's doing really well. Maybe it's revenue positive at this point. Maybe it's profitable. But what you have is a paper investment in a ton of shares that aren't yet traded on public markets. You don't know what those shares are worth unless you have comparable sales. You can do these like shadow evaluations by looking at the book value and so forth. But when you've got an innovative, fast growing company, it's actually quite hard to know, what is the future value of these shares? What do we think the odds that the company doesn't make it? Or, how many times do we expect revenue to grow before it plateaus? So all of those things make valuation really difficult. They make avoidance somewhat easier. And so the experience in Europe in general with wealth taxes is that they have not collected the revenue that was anticipated. They've caused a lot of inefficient avoidance behavior. And also they have caused capital flight, where people just look at this and say, no, I don't want you to take 5% of my fortune every year. Although, to be clear, no one has a wealth tax that high. And they move. And then you lose not only the wealth tax that you were planning to collect, you also lose their income taxes and other taxes they pay, like sales taxes.
I mean, this idea of the difficulty of valuing the fortune of a billionaire is really interesting. I mean, it's a problem that most of us haven't had to work through in our personal lives.
Not a big issue. Not a big issue for me.
Even of people who have like some retirement savings in a 401k, those, the value is pretty easy to see, but it does fluctuate on a pretty regular basis.
Yeah, this is another problem with these taxes, which is that if you want them to be, when the way we do capital taxation now is that we say, okay, well, you had an up year and you sold and you got a lot of income. But then some years you have a down year and you sold and you actually lost money on that sale. And we allow you, because the cycles, the unlike income where I get a steady check pretty much every month, these cycles in the capital markets, they're not steady, and so people offset. You have capital losses in one year, you can deduct those against your capital gains in another year, which is, by the way, if you've read about rich people who haven't paid who paid zero taxes one year, almost always what happened there is either that they just net lost money on their capital investments, or they had net lost a lot of money in another year, and then they were able to deduct those losses. And if you didn't do that, you would be actually penalizing people for saving and investing, because they would get taxed on any gain, but they wouldn't be able to offset the losses, and that reduces the overall expected return to saving and investing.
Generally speaking, Sanders says there are like 938 billionaires in this country. That's not actually not general at all. It's quite specific. They have a combined total of something like $8.2 trillion. How much is that 5% annual wealth tax that is being tossed around? How much is that purported to potentially add to the federal budget?
Well, there are varying estimates, and I think we've seen this in California as well, where if you look at the proponents of the plan, they're claiming they'll get like a very large amount of revenue. People who've done a kind of more detailed analysis, but the claims that you're going to get raise high revenue tend to be with pretty simplified assumptions, as you basically just you look at the number of billionaires and what their wealth is. You estimate some amount of avoidance activity, whether that is, deciding to move, deciding, like to trying to find other ways to offset your tax, deciding to invest in things that have a lower book value in order to lower your tax bill, and say get below the billionaire threshold, which I think you would see certainly at the margin, right? If you think about someone with $1.1 billion who's facing this wealth tax, if you're going to lose 5%, why not liquidate a bunch of that and spend it, or invest in things that like overpay essentially for assets, and bring yourself below the threshold? That only really works if you're quite close, right? You wouldn't do that if you had $30 billion. That wouldn't make sense. But it does at the margin. And the way wealth works, as I think we know from our own lives, is that the number of people at the bottom is larger than the number of people at the top. So you actually have more billionaires that are going to be close enough to the threshold to be interested in avoiding than you do the people with 200 billion fortunes. And I should disclose that Jeff Bezos owns the Washington Post, where I am employed. So my understanding is that the Bernie Sanders estimate is that they would raise about 4.4 trillion over 10 years, which is, out of that total wealth, because they would be taking that 5% bite every year. They expect to raise significant money. Realistically, I don't think that that's likely to happen for a number of reasons, including the fact that, remember, you are, first of all, you're taking that 5% every year, whether the stock, their assets go up or down. And so you're over time reducing the size of those fortunes. Now, I think for a lot of people, honestly, who advocate this tax, that is a feature rather than a bug. That is, I think that a lot of them don't really expect to raise that much revenue. They just don't like the fact that there are so many people with so much money, and they would like to reduce the size of those people's fortunes. But I think more realistic estimates are probably a fraction of what Sanders and Connor are claiming, simply because there are so many ways to avoid it. Even if you expropriate people when they leave, if I were a billionaire, I might look at this and say, you know what? I'll take a 60% hit once rather than a 5% hit every year.
When you say expropriate, you're talking about it could be set up so that if people decide they're going to move to another country and take their billions with them, the United States could levy a fine on the assets they have at that time.
We already do, actually. We already have a rule that says if you expatriate, we will hit you with a pretty hefty tax bill if you're a U.S. citizen who tries to move abroad, because the U.S. is one of the few countries that tries to tax. Most countries tax people on the money earned in that country. The U.S. levies tax on all worldwide income of its citizens. We give credits for people for taxes paid in other countries. So it's not a situation where, like, you're living in France or Denmark, you're paying 60% of your income in taxes, and then you also have to pay your U.S. tax bill. But we already penalize people who try to expatriate because we don't want them to take their tax revenue with them. But there's a point at which I think that might well make sense. I also think there are some real questions about whether a wealth tax would be constitutional in the first place, and you can certainly count on litigating that very aggressively.
Yeah, there is this study published by Columbia Law School that argues that federal wealth tax might indeed be unconstitutional. How so?
So in the Constitution, there is, because, the document was made for a much different country.
Billionaire free at the time.
Well, yes. Also, I think there were some millionaires. I think George Washington might have been one of them, but they were, like, very small. And I would doubt that George Washington was a millionaire. He was one of the richest people in the country. But no, like, the $1 million person was, I think, a ways off, but I would have to go back. Don't quote me on that. But the big thing was that they conceived themselves much more as a union of states rather than as the federal system that we now think of today, where people primarily identify as Americans and not like Virginians or New Yorkers. And so one of the provisions in the Constitution is that any what's called a direct tax, which is to say not an excise tax like a tariff, it has to be apportioned among the states in proportion to their population. So you can't just tax billionaires and leave everyone on their wealth and leave everyone else out of it. You would have to then allocate that state by state, and it would get very weird.
All right, Megan, I get why, no billionaire would think this is a good idea. I'm assuming that you are not a billionaire. So talk
Alas, no.
yeah, right. Talk a little bit about why it's not just you. Like Gavin Newsom in California, as dyed-in-the-wool a Democrat as one might find, he thinks it's a bad idea too.
California has a number of key industries. They've got agriculture, obviously. They've also got Hollywood, and they've got the tech cluster in the Bay Area. That tech cluster throws off enormous revenue in a way that's quite cheap to the state, right? So if you think about a traditional California industry like aerospace, well, aerospace is great, not in any way denigrating it. It takes a lot of land. It takes a lot of electricity. Now, AI might be changing this for Silicon Valley, but even so, they can cite the power hungry bits outside of California. It's not environmentally polluting. Most of its workers are quite high paid. And because these stocks grow so fast and have such nice profit margins, they throw off lots and lots of lovely tax revenue. And you can actually see this show up in both New York, which has a similar situation with the finance industry, where their tax revenues in those states are unusually dependent on capital gains. So I think the fear for Gavin Newsom is twofold. Number one is that billionaires are going to move out of his state and take not just, again, their wealth tax, but their income tax with them. And we have seen this is definitely happening. It's not clear how many billionaires are moving, but it is definitely something that is happening. And so for Gavin Newsom, that's a twofold problem. Number one is that if these guys all move to, say, it's probably Texas or Florida, both states with no income tax, with a pretty, business friendly environment. So if these guys move to Texas or Florida and there's now like a critical mass in Austin or in Miami, they're probably going to hang out together. And then they might decide to do some investments together. And maybe people move to be closer to them in order to get the opportunity to talk to them. And over time, you're diminishing the power of the California tech cluster and starting to seed it elsewhere. I think this has already really happened in Austin as Elon Musk has moved there. There's a pretty booming tech scene. I think that's less so in Miami, but I don't know, actually. I have not been to Miami. I have been to Austin and seen it firsthand. And so for Gavin Newsom, that is a crisis for the state of California. Hollywood has also, by the way, seen people moving productions out of LA because they get not only tax credits from other states, but they get the locations to shoot in California have been made quite expensive. The other thing you have to worry about is if you are someone who's a founder who, is thinking about taking their company public. Do you want to be in California after they've imposed a 5% wealth tax on all the billionaires in the state? Even if it's only one time, they say, and it's over, you've just got to think this could happen again. This is what the electorate is willing to do. I don't know. Maybe I just want to be in a state that's not going to do that to me. And then the third thing is thinking about the incentive to save and invest, right? All of us, every week or every 2 weeks when you get your paycheck and you have decided to deposit some portion of that into your 401k, you've made a decision to trade consumption now. You could certainly, I'm sure we can all think of stuff we would like to spend our 401k contributions on, but you've made a decision to defer that consumption so that you can save for your future. Well, rich people make those trade-offs too. And on the margin, if you think about a billionaire in California who could invest in a company, or he could take a fabulous 1-month vacation to like some incredible resort in Italy or a private island in near Fiji. On the margin, you want him to be investing because his investment in the state of California creates more jobs and opportunities and possibly future billionaires you can tax. And the vacation in Italy does not do anything for California.
The billionaires and their financial situations are so different from what most of us face. We should talk about this. I mean, exceptionally wealthy people, including non-billionaires who still have a lot of money, pay something like, it used to be 30% in annual income taxes. Today it's more like 24%. But income tax is really different from the kind of wealth being targeted in these, right? I mean, it's generally speaking a much smaller share of how much money someone at the billionaire level might have gained in a given year.
I mean, let's define what that gain is. If they sold stock, they paid capital gains tax on it. The people who say, well, it's actually a really small share of their income, they're looking at the unrealized capital gains. They're looking at the appreciation in this paper wealth. And I think there's a couple problems with that. And one is, if you imagine being taxed on your unrealized gains every year, you can quickly see why you would object to that, right? You say every year the taxman comes and says, well, it's a boom year. It's, I don't know, like it's 2007. Your house is appreciated by like 24% this year. So you owe income taxes on that. Well, but you're living in the house, right? You can't sell the house in order to pay the taxes, and you might not have the liquid assets to pay the tax. Um, which is like a pretty common situation for most people. Even now they struggle sometimes to pay their property taxes. Certainly in very high tax jurisdictions. Um, and so, like that issue of the paper gains versus the liquid wealth is an issue personally for the taxpayer. But the broader issue is that you can't spend liquid wealth. And I got into this a bit in the column. I want you to imagine an island. And I want you to imagine that this island, because it has very bad zoning policy and has just not allowing anyone to build any new houses whatsoever, well, they now have a problem, which is that housing is extremely expensive, great for existing homeowners, but very bad for people who need to rent a house. And a lot of those people are now like homeless and sleeping in a cave. And the nice government says to itself, well, this is terrible. Look at all that housing wealth. We need to unlock that housing wealth. What we're going to do is we're going to slap like a 10% property tax on everyone's house. And we're going to use that money to give people rental vouchers. And if you think about that for a second, this obviously makes no sense. I mean, for one thing, suddenly a lot of people are going to have to sell their houses. And which is going to cause the price of homes to fall if everyone tries to sell at once, right? As we saw during the financial crisis. And that means that you are going to collect less with this tax than you anticipate. But the other problem is you have not built new houses, right? You there's no actual new supply for the people who need homes. You have just kind of rearranged who wins the game of musical chairs. And that's also true of the broader economy. The wealth kind of blinds us. It's dazzling. These numbers are so big. But if you think about trying to expropriate that, those, whatever it is, $8 trillion, say, people imagine we could take that money and we could fund the US government for like 2 years. But that's not how it works, because the US government, first of all, if you took all of that money and then tried to sell it all at once, you would just end up with nothing, because the market would be all sellers, no buyers. But the other part of it is that the US government does not need stock certificates, which is what these people actually have. It does not need luxury estates or yachts. It needs like doctors and soldiers and guns and judges and all sorts of stuff. There's no way to transfer those stock certificates or the amount that billionaires are consuming in like fabulous vacations in Italy. There's no one for one translation into the stuff that the government consumes, which is what you actually have to do. And I find this is a concept that people just really struggle with, is that just try to imagine away the money for a minute. Don't think about the dollars at all. What Americans can consume on net is defined by how much Americans produce, plus like some stocks, like we have furniture. I guess I consume the use of my couch every year, right? And our cars that depreciate. And then there's a few kind of storable consumables like oil and fine wine that you can decide what year you want to use those things. But ultimately, like what we can consume is mostly about what America produces in a year. Taking the wealth from the billionaires does not make us produce anymore. There's no more stuff. We just transferred the pieces of paper, the ownership of the pieces of paper from one person to another. On the individual level, this can be a transaction that like you can do lots of things on the individual level that you can't do at scale, right? If I could get some of Elon Musk's stock, if you would give it to me, I could trade that for anything I want because markets have some slack in them. It's not literally true that like like every doctor appointment in the entire country is booked right now. I could take that money and I could turn it into a doctor's appointment. But the person buying it is lowering their consumption. And when you trace that transaction throughout the economy, what you are always doing when you tax someone is that you are getting them to lower their consumption of something so that you can turn that consumption into something else or give it to someone else. And you never see this on the individual level. It's all of these, like a zillion price transactions moving through the banking system. You don't see it, but at the aggregate, that's what happens. And that's why it's useful to just think about the supply of real goods and services rather than focusing on the dollar amounts, because the dollar amounts blind you to how much redistribution you can actually do. And I'm not saying that you cannot do any redistribution from billionaires, nor am I saying that like their tax rates are optimal and they should be exactly what they are. My point is just that like don't pay attention to the numbers on paper because you can't get your hands on the numbers on paper because that's a bit of an illusion in the same way that the price of your house is a bit of an illusion. The other thing is you're just limited to, so Mark Zuckerberg just bought a $170 million estate in Miami as part of his move out of what appears to be his move out of Florida. You could take it, but that wouldn't give anyone health care. You could give them, I guess, vacations on the estate, or you could, at great expense, rip it down and put a hospital there. But it's not like just a smooth, if we sold that estate, we could give people 170 million worth of healthcare. It's actually, there's a ton of friction. There's a ton of transaction costs there. And then there's also at the end some incentive problems, which is one of the reasons that governments have generally chosen not to tax wealth.
Just to make sure I understand, though, Megan, let's just assume, for the sake of argument, that we leave the problem of, creating liquidity to pay this tax up to the billionaires. They're the ones being assessed this levy. Sanders and Khanna are saying they would take the proceeds from that and redistribute it to working class and middle class Americans so that, like, every one of the 250 million estimated Americans living in households with incomes under $150,000 a year, they would each receive $3,000. Wouldn't the consumption that those people use that money for, wouldn't that have a similar impact on the economy as that same amount of money in the hands of billionaires?
Yeah, I'm not, again, arguing that you can't redistribute any money from billionaires. I'm arguing that the wealth tax is a bad way to do it. So part of the problem is that there's something called deadweight loss, which is that basically every time the government does a tax, you have reduced some economic activity that would otherwise have happened. So one way to think about this is look, if I jacked up your personal income taxes by 50%, a bunch of stuff wouldn't happen, right? There would be stuff you wouldn't buy. But there would also be, you might just look at this and say, well, why am I working if I'm now paying 70% of my income in taxes, right? Now, this is an extreme example. I'm using that as a kind of thought experiment, but smaller versions of that happen all the time where you're basically like with a sales tax, right? If I jack up the sales tax by 15%, some sales don't happen. Sometimes I look at this and think, yeah, I don't care enough about this to pay. I'll pay $1, but I don't really value it at $1.20. And so and look, you're more likely to see that on big ticket purchases like cars, right? Where this is really gonna hit you in a way that, so overall, right, you introduce these little frictions where some transactions don't happen and this is just net welfare destroying, right? So the transactions don't happen, which means I was willing to give you my hard-earned money for something, which means I valued whatever that thing is more than the money I was going to part with. And now that transaction isn't happening. But also, now we're not collecting revenue on that sale. That doesn't mean that overall revenue falls, right? I'm not claiming that that all taxes sort of destroy revenue. That would make no sense. But that deadweight loss going up through the economy, you always have to think about that. Um, and the other thing is that you're effectively, I'm going to go back to the capital formation problem. So if you think about the real return on assets, right, on someone's wealth. Now, for these really ultra billionaires, most of their wealth is in either privately held companies or some other kind of company stock, right? It's not like they have just giant estates. They have 90 million giant, very expensive estates. Um, but so let's take the average return of the stock market as a proxy for um, what they might be making on average. And that's about, like the real return, say 5% or 10%, somewhere between there, right? Now, this is not going to be true of the founders who are in that very early, like unicorn stage of growth. And it's also not going to apply to Elon Musk, who, for reasons some would elude me, the stock in his companies just goes up by $1 zillion every time he blinks. But remember, like most founders are not Elon Musk, and it would be illegal just to tax Elon Musk. That would be what the Constitution calls a bill of attainder. So, say you've got for a lot of rich people an average return of somewhere between 5 and 10% after inflation. Well, a 5% wealth tax is taking then somewhere between 50 and 100% of the return on investing, and that just makes investing less attractive.
This is not entirely theoretical, Megan, right? Talk about what happened in, I think it was Denmark, which established a wealth tax and then ultimately abolished it in 1997. Why did lawmakers there decide to do away with not a billionaire tax, but a wealth tax?
For the same reasons pretty much everyone else has gotten rid of their wealth taxes. You get people who move to avoid it, which especially in the EU, which has rate of movement, became a real problem. It's it's hard to administer. It's just a pain in the butt. You end up with a tax division that's solely devoted to arguing with billionaires over how much their art is worth. A lot of these wealth taxes are actually applied much lower down the income scale. So you end up with a tax division that's devoted to arguing with people about how much their art and their jewelry and their chateau that hasn't been sold in 200 years and all the rest of it. And it's just a pain for the revenue you raise. And then there's the effect on capital formation. And so between all those things, people just looked at this and said, there are better ways to raise this money. You can raise their income taxes, which then relates the tax that they're paying to what they actually made. And I think broadly, the way we should think about the tax system is that we should tax money when it hits a person, and that we should tax it at the same rate. So, like, I'm about to make people angry, but I think we should eliminate the corporate income tax with maybe like a token tax to make sure that people don't try to shove all their income through corporations, enough to make the corporations keep records of what they're paying you and so forth, but not enough to make them make any decisions about it. Say a 1% corporate income tax, not a corporate income tax that is just not worth evading. But then I think we should get rid of the special capital gains rate and just tax income progressively when it hits a person a single time, when it becomes cash. This is a more progressive system because if you think about the corporate income tax, it's often falling on people who have small numbers of shares, and so forth, or it falls on nonprofits that have shares. And if we wanted to tax those nonprofits, then we shouldn't let them be nonprofits. And so this would actually be, in a lot of ways, a fairer system, but it would also just be a much more efficient system. Companies spent an enormous amount of time dealing with audits, structuring activities from higher taxed activities into lower taxed activities. You can say they oughtn't to do this. I might even agree. It doesn't matter. They are going to do this if the tax rate makes it worth it. In just the same way that, we give a tax break for mortgages, and that means that some people buy houses who might otherwise be happy renting. Maybe they shouldn't do that, but they do. It would just actually be much more efficient to say we have one form of income We don't really do deductions because the operating expense, unlike a company where you really have to think about like, what are the expenses of this company and how does that relate to their income? Because otherwise you would end up with companies with high profit margins would pay less in relative taxes to their actual income than companies with low profit margins, which is pretty much the opposite of what you really want to do. So we tax corporate income, which means a lot of deductions and so forth, because we don't know, because their operating expenses can vary so widely, right? You can have a retail store that has a 1% profit margin and that is highly capital intensive. You got to keep all that stock and so forth. And then you can have a consulting firm where their only expense is like a laptop and some toner for the printers. Um, and you have to look at that for each individual company. For a person, the operating expenses for a human being don't vary that much. Healthcare is the big exception. But other than that, like it's not like some of us need to eat foie gras and caviar while others can live on hot dogs. So,
Although that's the reality in this country, but yes, continue.
right, but that's not necessary, right? We don't have to account for that in the tax code.
Right.
We can just say we have a standard deduction. It's $24,000 a year. Everyone gets the same standard deduction, right? And so it's actually more efficient to tax people as well. And so that would be my preferred way of doing this is you tax billionaires when they sell something. Or, you can argue you tax billionaires when they borrow money on their shares. This is a famous strategy called buy, borrow, die, where the idea is that you borrow money against shares you own and live off those proceeds. This has been somewhat exaggerated how common this ever was. It's now not. It doesn't make sense now because interest rates are quite high. It only really made sense in a zero interest rate world when like stock prices were going up very fast and interest rates were effectively zero. But if you're worried about that, you say, look, you borrow money on shares and you use the money to live on rather than to invest, and we're just going to treat that as if you'd sold the stock. But tax human beings. Don't try to like and tax them progressively. Absolutely, someone with $1 billion should pay a higher rate than someone who makes like $30,000 a year, because the billionaire can spare it and the person who makes 30,000 can't. But I think we overcomplicate stuff in an effort to get cute when the easy thing to do and the right thing to do is to tax money when people have access to that money to spend on stuff.
Okay, so I think I'm following your argument here. A progressive tax seems to make sense on, let's just leave corporations aside and talk about individuals here.
Sure.
It does seem like whenever Congress is talking about taxes, there are lots of cuts scheduled for the wealthiest income earners. Why can't we drum up the political will to just have higher personal income taxes for very wealthy people?
Well, I think there's a few reasons. Number one, I think Republicans are unhealthily fixated on tax cuts, although Democrats are now becoming unhealthily fixated on it too, which has been this was the development I did not have on my bingo card for 2026, where you have all of these Democrats, including Bernie Sanders and Ro Khanna, but also then Chris Van Hollen, Cory Booker, Katie Porter in California, coming up with these plans to cut taxes or issue rebate checks in the case of the Sanders Khanna plan for people with fairly middle class incomes. And I really did not expect that. I've been saying to Republicans for a long time, I mean, since before the Great Recession, that the Reaganite tax cuts had just run out as a political strategy. Most people do not pay very much in income taxes. They pay a lot in payroll taxes for Social Security. But in terms of the rest of it, the bottom two quintiles pay no income tax and in fact have negative income taxes. The third quintile, that's the bottom 40% of the population, like net of credits does not pay any income tax and in fact gets money back from the government. This is just, there's not a lot of voters who are desperate for tax cuts in the way that was really true when Reagan was doing this, in part because income taxes were higher on like the great majority of voters, and in part because brackets didn't used to be indexed for inflation.
Hmm.
So when inflation was going up really fast in the 70s, you had people who they weren't getting any real raise, but their taxes kept going up because would get pushed into successively higher brackets. But I've been saying that's a dead end for a long time, and I don't know honestly why Republicans are so obsessed with it. It doesn't do them any political good. Um, I don't know why Democrats are now getting in on the act, because it will absolutely gut their ability to raise money to pay for the programs that they want or that they say they want. Um, there just is something alluring about the idea of that people shouldn't have to pay for government. It should just fall from the heaven like the gentle rain. Um, and I don't know what to do about that.
How do the welfare states of Europe that, generally speaking, take on the obligation at the government level to ensure that every person has basic needs met, like food, shelter, and healthcare?
They have incredibly high marginal tax rates on people that in America would be considered somewhere between working and middle class. And this is something, and they also have something called a value added tax. Basically, the idea of a value added tax is that it's kind of like a sales tax, except it's collected on each person in this. Like, so you take ore out of the ground, right? When you sell that, the VAT applies, whatever that is. Like say it's 25%. So the government takes 25% of that. And then when the next stage, the person who refines the ore, who smelts it into iron, say, uh, they have to pay when they sell that iron to someone else who's going to make it into steel or whatever. They also have to that pay a 25% sales tax on that iron, but the guy who bought the ore can now deduct the price of the ore from the amount that of sales tax that he pays. So basically, the reason this is really efficient, so you can basically just think of it as a 25% sales tax. But unlike a 25% sales tax, because each person in the chain pays it and then can deduct the cost of the stuff they bought, it's kind of self-enforcing. If the guy, if like the guy who dug the ore out of the ground tries to cheat on the VAT, other people won't be able to get their rebates, and therefore they will like narc out the people down the chain who attempt, because they do not want to pay the full 25% on all of it. And so it's just a very self-enforcing sales tax that collects an enormous amount of revenue. But then the other thing is that marginal rates kick in at levels that just astonish Americans. So Denmark's second to last, like it's what used to be its top tax rate. They just did a little bump, but it's over 50%, and it applies at like $85,000 US of income.
People are not paying as much or anything for things like healthcare and childcare that we have to find the money to pay for out of our own income, right?
Absolutely. You can absolutely argue that. I think the distributional effects are clearly that this redistributes down the income ladder. The flip side of it is that their capital markets are a lot less deep than the US capital markets, which is one reason that when you talk to entrepreneurs in Europe so often, and I've spoken to quite a few of them, and they're not like traders to their country. They don't. So why do they end up moving their companies to America? Number one is the talent pool that's available. With American, at least until this administration, like we just have this incredible pool of both native and foreign-born talent who come through the American university system. But the other reason they move is the capital markets. They're just so much more developed here and so much deeper. And if you are looking to grow your company, getting access to that capital is just absolutely key. So there are trade-offs to it. And I think in general, something that people should keep in mind. And look, I'm not arguing that the United States currently is at the socially optimal level of taxation and redistribution. But the thing I would like people to keep in mind is that, first of all, you have to redistribute stuff. You can't redistribute paper wealth. The second thing is that you need to think about the trade-offs. And the third thing actually is that the European welfare states do not do it by taxing the rich. If they could have done it, they would have tried. I mean, they did try. They couldn't do it. They do it with very high, broad-based taxes on very ordinary people. And anyone who tries to tell you that they can give you that welfare state without raising your taxes is lying. And then the last thing that I would ask them to remember is that American policy matters more than policy in most of the rest of the world. Not because we're better, but because we are the biggest rich country and we are the technology frontier in most industries. Or in many, let's say, in many high growing industries, things like AI, things like, the web and so forth. Things like pharmaceutical research, often done abroad, but increasingly done here. And the American market is what pays for it.
Megan McArdle is host of the Reasonably Optimistic podcast. She's a columnist at The Washington Post, which published her essay, The Myth of the Billionaire Wealth Tax. Megan, thanks so much for making time to talk about this.
Thanks for having me.
Think is distributed by PRX, the Public Radio Exchange. Find us on Facebook, Instagram, anywhere you get podcasts, and at think.kera.org. Again, I'm Chris Boyd. Thanks for listening. Have a great day.
From PRX.